Forex Focus brought to you by IG. Doing some price analysis today on the euro dollar market, continuing its fall after the recent ECB meeting, first one of the year. No change as expected, but a little bit of puffing out the chest, hawkish talk from Lagarde and the European central bankers. But the market went against Lagarde. Euro has been down to start the year, and you can see the most recent red bar from today pushing it closer and closer to 108. We haven't traded 108 since mid-December, coming off of the last Fed meeting of the year. Euro ripped right through 108 and continued on to 111. Since have backed off more than 200 pips, almost 300 pips at this point, from above 111 close to 108. And yeah, today's ECB no different from the majority of price action in 2024, which is euro lower, dollar higher. And a lot of this is dollar strength, but for a majority of this recent price action, euro was down and Canadian dollar higher, Australian dollar higher, pound relatively stronger than euro, and yen relatively stronger than euro. And so I want to go a little deeper on this euro, take a look under the hood and see where the weakness is coming from after this ECB meeting, and if there's a case for greater weakness or strength. And it depends on how you're going to view this relationship, because the ECB held rates unchanged at their January meeting. And the current environment shows the US there at the bottom of this table, 5.5%, and the euro area, 4.5%. So about 1% difference. And keep in mind, a lot of the forex price action that you're going to see, a lot of the demand comes from the difference in interest rates. No coincidence whatsoever that the US dollar versus the Japanese yen has seen historic demand in recent years as the US interest rate environment has gone up to 5.5%, and the Japanese has stayed in negative territory. And people have wanted that US dollar so that they can invest at 5.5%, and have used the relatively cheap Japanese interest rate to sell that yen to buy that dollar, and pay negative 10 basis points, negative 0.1% to short that currency. But let's get back to this euro, because at the meeting, no change. And Lagarde even comes out at the start of the press conference, says it's premature to discuss rate cuts. Now, they did go on to discuss rate cuts and that it might be time to cut in the summertime, or as soon as the springtime. But you saw the euro weaken in the face of these comments, whereas the hawkish comments at the December ECB meeting, you saw the euro rally after that December meeting and then let down here in January, and the trends continued here post ECB meeting. And this is a classic case of the market going against the central bank. It happens all the time, and inevitably one is correct. And in this case, either the ECB is not going to cut that soon, or they're not going to cut that far here in 2024. And the euro market is wrong and Lagarde is right, or the ECB does end up cutting a lot here in 2024, at least, more than the US, given the weakness, the relative weakness you're seeing to the US dollar here that the market has been projecting the last couple of weeks. And Lagarde is wrong. So the market right, Lagarde wrong. And that would be more rate cuts, more euro downside, versus Lagarde being right, less rate cuts, and the euro bouncing back. Only time will tell, obviously, because you look at the US scenario, and we're looking at the March Fed meeting. Why aren't we looking at the January one? Well, central banks across the board here in January, whether it was Canada, Japan, Euro area, UK, I think meets Bank of England meets next week with the US. No one was really expected to do anything. No change here in January in terms of expectations. Now that could change for the US or Bank of England. But the expectation is maybe as soon as March, there will be some rate cuts. And you can see it's really as close to 50-50 as it can get, 46% chance of the rate cut, 53% chance of no change, essentially 47, actually, 47, 53, whatever you want to say, really close to 50-50. And the strength we've seen in US dollar is actually on some of these relative cuts now being priced out of the US and maybe being priced more into the euro area, because looking at the euro dollar price action and then laid on top of it, I threw the US 30-year treasury yield. Looks like no coincidence whatsoever, right? That you've seen treasury yields bounce back by 10 to 40 basis points, depending on what part of the curve you're looking at. For the 30-year, it went from below 4% to now around 4.3, 4.4%, close to 4.5%. So quite a bounce back there. You're seeing, and this is a funny thing, right? It made a lot of sense when the U.S. was hiking interest rates, that the U.S. was outperforming, it was appreciating, because it was like, oh, they're hiking rates faster and further than the euro area and Japan, obviously, and these other places. But now on the flip side, on the potential cuts, at the end of last year, a lot of cuts priced into the U.S. and not so many in the euro area or UK, these other places. And now, starting to price out some of those cuts and maybe some potential for more in the euro area. And so it's US dollar strength, not on US strength per se, but relative strength in that they maybe aren't cutting as much and maybe Lagarde will end up cutting. Now, all of that being said, the ECB continues to hold this stance of, we're not even really looking at cuts in terms of their decision and their actual statement. They want to set rates at sufficiently restrictive levels for as long as necessary to get inflation down to the 2% target. That being said, their last inflation readings were in the mid twos already. And so if they get, a February inflation and a March inflation that are at essentially 2.1, 2.2, 2.3%. They're already at, I think the last reading was maybe 2.7, right up there. Then maybe they are ready to, maybe the sufficiently restrictive levels for as long as necessarily only has to be maybe a month or two. We'll see. They're definitely trying to present as hawkish, but the price action obviously going against them. And actually, here, I forgot, I have the inflation for you right now. Because the question is, will they cut sooner than the U.S.? Or at this point, it feels like even if both central banks cut in March, or they both cut in April or May or whenever the next meeting is after it, after March, I think it might be the first week of May. If they both cut at the same time, at this point, that kind of feels like a win for the U.S., right? Because the U.S. is already at 5.5%. I showed you that to start the show, in the euro area at 4.5%. And so if they incrementally move lower together, the U.S. dollar might retain some of its strength. And you see euro area inflation already in those twos. It was actually higher than I thought, 2.9% recently, but printed 2.4% back in November. So we'll see what happens here. The U.S. has some inflation readings coming up as well before and after the FOMC. So if they print, 2.5, 2.4, 2.3%, maybe the U.S. will cut sooner. But again, this is all relative rates, whether it was hikes to the upside or cuts now to the downside. And I wanted to illuminate that further with the example of when we saw sub-parity prices for the euro relative to the dollar in 2022. This was at a point where the U.S. had hiked up to, in September, the U.S. got up to above 3%. And the euro area was still below 1.5%. And so that was a gap of close to 2 percentage points. Now we're only at 1 percentage point, and that makes sense. I mean, look at the price action here from euro dollar. Got down to 96 cents at that point. It has since rebounded to 105, 110, where we've been trading a lot the last year or so in that range. But that has coincided with this gap going from a 2% gap to a 1% gap. And now the future price action here, of course, anything can happen. We've got, wars going on globally. Anything can change on a dime. Any news item can come out of nowhere. But theoretically speaking, broadly speaking, you would expect that if the globe is looking at rate cuts and the euro area cuts by 1.5% here in 2024, and the US only cuts by 1%, and that gap widens from a 1% gap to 1.5%, then the dollar might regain some strength. Maybe euro gets down to 105 or 104 if they cut more than the US. If they cut by 100 basis points more than the US and that gap widens to 2% again, maybe parity back in play. On the flip side, if the US is the weakest on the way down, so to speak, in the interest rate environment, then euro maybe gets back to 110, maybe 115, a price level it hasn't been to in 2 years now. A lot on the board here, but recent trade, euro weakening, central bankers trying to present as hawkish, but the market's saying, we think the rate cuts are coming, not only from the US, but the euro area. Now we get to sit back and trade it as we get closer and closer to these actual rate cuts. So a lot of fun to be had. Not to mention that at any point, inflation could rear its ugly head again, and there could be no rate cuts. So many unknowns on the board here, but leading us to plenty of potential trades. And right now, the market, for the most part, in a cutting environment, even though we haven't seen the cuts yet, the question becomes relatively, who's going to cut more?